Stocks are reacting to negative news flow.
Okay, we've got a very special guest now joining us. Dan Fineman is co-head of equity strategy, Asia Pacific at Credit Suisse. Dan, great to have you with us here on the program. Thanks very much for your time. You, Dan, at CS remain cautious, right, with regards to a U.S. recession. But there are those who say, and we'll come to what you think will the shape and size of the recession in the U.S. will be. But there are those who already argue that, a softish patch of growth in U.S. bodes well for emerging markets, and that's been historically true. Would you agree with that, Dan? What's your sense?
I would agree with that. I think if we have a very hard landing in the U.S. of a recession as deep as the Great Global Recession in 2008, 2009, that would be bad for Asia and emerging markets. But a slowdown of the magnitude that we're expecting for the U.S., actually, it could be pretty good for Asia. One factor is it could lead to a weaker dollar, and a weaker dollar typically is associated with good performance for emerging markets, Asia included.
Okay, so a sharp recession in the U.S. is bad news for all emerging markets. A soft landing in the United States may spell good news for emerging markets like India. And then India's growth rate of 6-7% also starts looking very attractive, right? Dan, one question that a lot of investors are asking is, why should I take risks going into 2023? Because Federal Reserve still indicates that we have more rate hikes to go. They're going to stay at peak levels for longer. That uncertainty remains. And on the flip side, I'm getting some very good yield on my fixed income. And this is a question that all over the world investors are asking. Your thoughts on equity versus fixed income for 2023?
Well, I think that your point certainly applies for the U.S., where equities are really still quite expensive relative to fixed income, and where the impact of a recession in the U.S. would hit equities much harder than it would hit bond markets. In Asia, though, I think the story is a bit different. In Asia, the economic downturn isn't going to be as great. Equities aren't stretched. Some markets are looking expensive, but in aggregate, Asian equities look a lot cheaper than U.S. comparables. So I think in Asia, the equity versus fixed income argument is tilted in the direction of equities. In the U.S., it's a different story.
All right. Hi, Dan. Morning. I'm happy to hear, actually, that you have upgraded India from the underweight stance. If you could tell us what's the incremental money, where does it flow? China's very attractive valuation-wise, while India, well, we are going to be giving growth. So how do you weigh in on both these two? Incremental money getting into 2023 goes to which market?
Well, I think at the moment, it doesn't have to be an either-or choice. It could be a win-win for both markets. I think that India still has some important strengths relative to other markets in the current global environment. India has a very robust economic cycle. It's got a good structural outlook in an environment where developed markets are heading into a slowdown. India's good growth, I think, deserves to trade at something of a premium. China has a cyclical upturn coming out of a deep downturn. Its equities are very cheap. And I think that there are good arguments for both of them, at least for the next several months.
Okay. Got that. Dan, so when you began by saying the U.S. slowdown, what you were expecting, the size of it. So you're expecting a soft patch, right? Nothing large or extended or very deep. Is that correct?
We expect a recession, but a mild recession, not on the scale of the 2008-2009 recession. The key difference is that right now the financial sector, the corporate sector, the household sector are much stronger than they were in 2008. Leverage is much lower. Deep recessions are typically associated with deleveraging events, and that's not the situation at present. What we have is a garden variety, fairly mild, short-lived recession lying ahead of us. This is still quite negative, I think, for equities in the U.S., but it's not going to derail better performance for emerging markets or Asia.
But would sort of a very mild recession bring the inflation problem under control to the Fed's liking? Isn't that, I mean, it's like a loop, right? So to get inflation to 2% or under, would just a soft patch of growth do, Dan, in your opinion?
It will definitely help the Fed's job, and I think, the Fed is clearly hoping for the economy to slow down. This is how you bring inflation down. It's no pain, no gain at the moment. The question, I think, for equity markets isn't whether a slower economy will help the Fed's job. It's how quickly will inflation
Okay, I think we lost.
Pivot to rate cuts.
So Dan, if we are in for a mild, garden variety, short-lived recession in the US, does it make sense for investors in India to look at export or global facing sectors like metals as well as technology? Because these are the sectors which have underperformed this year on fears of the global uncertainty, the macroeconomic uncertainty, etc. Do you think that will reverse in 2023 and it's time to look at global facing sectors out here in India, i.e. metals as well as information technology?
Not yet is the short answer. I think that we will have that opportunity, but it'll probably be closer to the middle of the year. I don't think that the U.S. economy or Europe will be bottoming out until late in the year. You'd want to position for that maybe 2 quarters in advance. So we're talking about sometime into the first half of the year before you would want to make that pivot.
Dan, you're suggesting that if you're going to get a mild recession, your preference will be to Asia versus the United States in terms of equity markets. What's the preference within Asia, though? You also mentioned that India and China both get equal share of money. Within Asia, what's the preference, and where would you lighten positions?
Well, we have been most enthusiastic the past year and a half about ASEAN markets, Indonesia, Thailand, Philippines. This remains our biggest overweight, but these are small markets. If you're talking about larger markets, China is still, I think, the best story. The valuations are still actually quite cheap. Even after this great rally they've had in November, the multiples are still at a deep discount relative to the rest of the region and relative to global equities. Our clients are still, I think, underweight China, but they are interested in playing into this cyclical recovery.
Just to stick with China, we are hearing of with the reopening, a wave of infections in China. And it's, of course, more amplified on social media, on Twitter, etc. But mainstream news outlets are also picking this up. I think yesterday the U.S. State Department put out I think when asked, the spokesperson said the outbreak is widespread and they hope it's contained. Any thoughts at all, Dan? Are you paying attention to it? Because if it gets too difficult to handle, this reopening may not be as smooth. What's your sense?
Well, first, from a human perspective, we're all hoping that the outbreak is mild as possible, and that as few people as possible die. From a market's perspective, I don't think that what we're seeing right now necessarily changes the equation. What markets and ourselves were hoping for, say, a month ago, was a slow, staggered, say, 3-month process of gradual reopening. What has happened instead is that they have lifted the zero COVID restrictions much quicker than we had anticipated, but it's not leading to a quick normalization of consumption behavior. And the bottom line is that 3 months from now, we're going to be where we were anticipating already, say, back a month before, which is that you're not going to see a normalization of consumption patterns until we get into, say, March. That's still the base case.
So talking about the base case, what are the kind of returns that we can expect from the Indian markets if the recession in the US is mild, emerging markets do better, in that China outperforms India? But in your base case assumption, the returns that Indian equity markets can see, and what happens if things go south? The downturn is far more severe. Then what's the downside scenario as you see it?
Well, I think that we can probably expect positive returns, not greatly positive returns for India, given where the valuations are right now. But you have good earnings growth. There isn't a strong argument for the market to be derating. So I think that we can hope for some moderately positive returns for India. The main risk, I think, would be global. If the recession in the U.S. is deeper than we're anticipating, then that would be quite negative for global equities, emerging markets, India included.
All right, Dan, good speaking to you. Thanks so much for joining in and giving us your opinion. We're going to get into Christmas, so wishing you and your entire team a very Merry Christmas in advance, and we look forward to chatting up with you in 2023 as well. Well, for the time being, though, we'll slip into a short break. You come back, and as always, we'll focus on the top stocks that you need to track.